Something is broken in the silver market, and the people who are supposed to tell you about it are completely silent. Not broken like a bad quarter. Not broken like a temporary dip. Broken like a clock that is still ticking but showing the wrong time, and the entire financial system is scheduling its day around that wrong time without realizing it. Right now, as you watch this, silver is being priced at two completely different numbers on two sides of the planet. New York says one thing. Asia says something 40% higher. And in a world where arbitrage traders have computers, algorithms, and billions of dollars specifically designed to close gaps like this in milliseconds, that gap is not closing. That should stop you cold. Because when a price gap that large persists between two of the world's biggest markets, it does not mean one side is wrong. It means the mechanism that is supposed to connect them has quietly stopped working. And when that mechanism fails in a commodity as critical as silver, the consequences do not stay inside the silver market. They spread. I am OG Peter, and this is Silver Dispatch. What I am going to walk you through today is not a trading tip. It is not a price prediction. It is a forensic examination of how the global silver pricing system has fractured into two separate realities, why the New York number you see on your screen is increasingly disconnected from the physical world, and what the 40% gap is actually telling you about the structural condition of the market underneath. Let us start where every serious analysis must start. Not with prices, with systems. The global silver market is not a single unified exchange where buyers and sellers meet and a fair price emerges. It is a network of interconnected regional markets, physically linked by the movement of metal, and financially linked by arbitrage mechanisms that are supposed to keep prices coherent across geography. COMEX in New York handles the dominant futures volume. The Shanghai Futures Exchange handles Asia's price discovery. London operates the over-the-counter spot market that institutional players use. Under normal functioning conditions, these three nodes produce prices that stay within a fraction of a percent of each other. Not because regulators force them to, because traders make money closing the gap, and that profit motive is powerful enough to synchronize global prices almost instantly. That synchronization has failed. The 40% premium that Asian physical silver is commanding over COMEX futures is not a rounding error. It is not a data glitch. It is evidence of a fracture running through the foundation of global silver price discovery. And that fracture has a specific cause, a specific timeline, and consequences that are still accelerating. To understand how we arrived at a 40% pricing gap, you need to understand the three layers of failure that built on top of each other in a span of roughly 90 days. The first layer is the refinery collapse. Between December 2025 and January 2026, 5 of the world's most significant silver refining operations either suspended intake, issued force majeure notices, or restructured their delivery commitments without warning. Johnson Matthey's Salt Lake City facility went dark. Metalor in Switzerland restricted operations. Heraeus in Germany suspended silver refining. Asahi and Umicore followed within weeks. Combined, these 5 operations represented over 126 million ounces of annual processing capacity, removed from the pipeline in a period of roughly 6 weeks. Now here is the detail that the mainstream coverage consistently omits. The reason these refineries stopped was not equipment failure. It was a financing collapse. For years, major institutional refiners had been providing interest-free working capital advances to smaller regional processors, allowing them to carry silver inventory through 30 to 60-day processing cycles without needing their own balance sheet to absorb the cost. In October 2025, those advances were slashed from near 100% to as low as 30%, and market rate interest was applied to what remained. Regional processors could not survive the arithmetic change. Backlogs exploded to 3 and 4 months overnight. The financing failure preceded the operational shutdown. The closure was the consequence, not the cause. The second layer is the inventory drawdown. COMEX registered silver inventory, the physical metal actually available for delivery against futures contracts, has fallen from approximately 346 million ounces in 2020 to approximately 76 million ounces by early 2026. That is a 78% decline while futures contract volume remained elevated. In a single week in January 2026, 33.45 million ounces were physically withdrawn from COMEX registered inventory. That is 26% of the entire deliverable pool, gone in 7 days. The coverage ratio, the percentage of outstanding paper contracts that could actually be satisfied with registered metal, now sits at approximately 13.4%. Exchange analysts historically flag below 15% as stress territory. The third layer is China's exit as the overflow valve. When Western refineries fail, the conventional assumption is that Chinese capacity absorbs the displaced volume. China controls between 55 and 70% of global silver refining capacity. That overflow valve was closed on January 1st, 2026, when China implemented silver export licensing requirements, reclassifying refined silver as a strategic resource rather than a freely traded commodity. Every industrial buyer in the United States and Europe who had been counting on Chinese refined silver as a backup supply is now competing in the same constrained physical market with no alternative remaining. 3 layers of failure, 6 weeks, and the paper price in New York barely moved. That is the fracture. If you are watching this and recognizing that the structural forensics Silver Dispatch consistently delivers are exactly what is missing from mainstream financial coverage, then subscribe right now and hit the bell. Because what I'm about to walk you through is the part of this story that no major outlet has assembled in one place. The 3 forces that are not just sustaining the 40% gap, but actively widening it. The first force is 5 years of accumulated deficit. The global silver market has consumed more silver than it has produced for 5 consecutive years. The cumulative physical deficit from 2021 through 2025 exceeds 800 million ounces. The Silver Institute projects the 2026 deficit at over 46 million ounces, making it the 6th consecutive deficit year. The buffer inventory that historically absorbs supply chain shocks, the floating stock held across dealer networks, vault systems, and refinery queues, has been spent down across half a decade of structural imbalance. A disruption that the system could have absorbed in 2019 becomes a crisis in 2026 because the safety margin no longer exists. And the demand driving those deficits is not softening. Solar manufacturers consumed more than 25% of global annual silver supply in 2024. Solar installation grew 64% in the first half of 2025. Electric vehicle silver demand jumped an estimated 20% in 2025. The math does not resolve regardless of how manufacturers try to run it. The second force is the lease rate signal. In any normal supply environment, 1-month silver lease rates sit between 0.3% and 0.5% annually. By late December 2025, those rates had surged to between 7% and 15% at various institutional data sources. When lease rates move parabolic in that manner, the signal is precise. The remaining holders of physical silver available for immediate delivery are commanding emergency premiums. The price system is communicating in the clearest possible language that deliverable silver has become operationally scarce. The third force is backwardation. The silver market entered sustained backwardation beginning in October 2025 and has held it. Spot prices trading above futures prices is not a technical chart pattern. It is the market communicating that nobody with physical silver trusts the forward supply chain to deliver. It is the pricing mechanism saying directly that possession today is worth more than a promise of delivery tomorrow. Now let us examine the mainstream resolution narrative, because it is failing on every specific point it makes. The claim is that prices ran up, some disruptions occurred, capacity normalizes in a quarter or two, and the gap closes. That analysis breaks down on 4 grounds. The refinery capacity is not returning on any predictable schedule. No institution has authority to force resolution. Substitution cycles run 2 to 4 years minimum. And normalizing refinery throughput does not replenish 800 million ounces of deficit. It merely stops the drawdown from accelerating. Stopping the compounding is not the same as resolution. Here is the question that this entire analysis builds toward, and I want you to sit with it seriously rather than scroll past it. What exactly is the New York paper price of silver measuring right now? Because it is becoming genuinely difficult to argue that it is measuring the cost of acquiring physical silver in the world that actually exists. Silver's COMEX futures price reflects a derivatives market that was architecturally designed to price a commodity with a functioning delivery pipeline, a liquid refining network, open geographic arbitrage, and buffer inventory capable of absorbing supply shocks. Not one of those conditions currently exists in full. The pipeline has impaired nodes. The refining network lost 126 million ounces of annual capacity in 6 weeks. Geographic arbitrage has broken down as evidenced by the 40% gap that arbitrage mechanisms cannot close. Buffer inventory has been drawn down by 5 years of structural deficit. The price printed on your screen each morning is a number derived from a system designed for a world that functionally no longer exists in several critical respects. And the 40% spread between New York and Asia is the most visible symptom of that disconnection. Consider what the behavior of the largest market participants is actually revealing. When COMEX registered inventory drops 26% in a single week, that is not a trading position. That is strategic accumulation occurring inside the structural cover of normal market mechanics. When lease rates surge from 0.5% to 15%, that is not a temporary dislocation. That is the people who know exactly how much physical silver exists and exactly where it is, concluding that holding it is worth an emergency premium over lending it into the market. Physical silver is being treated by the actors who actually move markets as a strategic resource, where possession commands a premium that paper contracts cannot replicate. The 40% gap between New York and Asia is not a pricing inefficiency, waiting for a clever arbitrage trade to close it. It is evidence that the physical market has fractured into regional pools with genuinely different supply conditions, and that the unified global price COMEX is supposed to represent has become, in several meaningful ways, a fiction. The question worth your genuine attention is whether the number you see quoted for silver each morning reflects the world as it is, or the world as the paper market was designed to represent before the refining infrastructure began failing, before the cumulative deficit reached 800 million ounces, before China reclassified silver as strategic, and before registered COMEX inventory fell to 13.4% coverage. That gap between what the paper says and what the physical market reveals is the most important data point in this entire story. I am OG Peter. This is Silver Dispatch. The paper price and the physical reality are telling two different stories. Which one do you believe? Drop it in the comments. The most interesting argument is the one this channel needs to hear.